and gold had 11 years up, in a row.
Mhm.
And silver outperformed gold most of those years. It had some off years, in other words, one year over year like gold was, but it did well, very well. When we met, if you would have asked me that we're going to go through this long U formation, meaning from the top all the way down, 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 finally hit a bottom after years, then and get all the way back to what's called a round trip, where gold's back around the top of 2000. And it's going to take till 2023 to do so.
DavidMorgan, the founder of the Morgan Report, has been a prominent advocate for considering gold as a viable investment option. He underscores gold's significance in wealth preservation and highlights the keen interest of central banks in acquiring gold as a part of their monetary reserves. Morgan often refers to the price patterns of gold and silver, describing them as resembling a U-shape when depicted on financial charts. This pattern reflects periods where both metals' prices initially performed strongly, followed by a significant dip, and then a gradual recovery to previous levels. Recently, gold prices have remained relatively subdued due to cautious investor sentiment ahead of the U.S. Federal Reserve's policy decision. The surge in fuel prices has added to inflationary concerns, contributing to this apprehension. Meanwhile, silver markets have been experiencing a rally, with silver traders closely monitoring the impending Federal Open Market Committee meeting. One of Morgan's central arguments is that gold's performance has consistently outpaced stock and bond indexes since the bottom of its price cycle up to the present day. While stocks have occasionally outperformed gold and bonds over specific 30-year periods, shorter 15-year periods have seen gold outperforming both stocks and bonds. Notably, from 1990 to 2020, the price of gold saw an impressive increase of approximately 360%. Over the same 15-year time frame, bond returns lag behind those of both stocks and gold. Morgan asserts that gold is currently worth much more than its current price when you compare it to the amount of money in circulation. Before diving into DavidMorgan's insightful interview, subscribe to our channel and give this video a big thumbs up.
The fundamentals for gold have only gotten better. I called the run to gold months ago, and I'll be vindicated. Not that it's about me, it's the message, not the messenger. But the idea is that the smart money gets back into gold soon, relatively soon. And the central banks bought more gold in 2022 than they had in decades. And that's the smart money. And even though they poo-poo gold on CNBC and the main financial channels, and they only seem to feature a gold feature when gold is down, the truth of the matter is that gold does well for preserving your wealth. And I'm going to digress for a minute, but they would be better off. Now, I have to be fair. That's from roughly the bottom to now. But if you measure from the bottom to now, stocks, bonds, and gold has outperformed everything. So now, has it outperformed a certain stock? No, but it's outperformed the indexes. Gold has outperformed the S&P 500. It's outperformed the bond index. So back to you, Kerry. But, gold, I just want to go on a minute more. Especially early on, he's like, oh, he's only a gold bug. He doesn't know what he's talking about. But if you stealthily ask the question of one of these radio hosts, especially the mainstream that are kind of undereducated about precious metals, said, if I could give you an investment that had a compounded annual growth rate of 10% per year, would you be interested in? And of course, the host would say yes. So, well, the one that's done that's gold. Name me another one that's done a compounded annual growth rate of 10%. And they wouldn't be able to come up with. I would say that gold is very undervalued relative to the money supply. Mm-hmm. Because if you look at what's the paper price of gold, it's a very easy equation. I put it out. One of my first internet articles is still floating out there in cyberspace somewhere, called Engineering the Price of Gold. And you take what the Austrians call base money or true money supply, which is M0. So that's the amount of paper. So you put that on the numerator. Then you take the amount of gold and you divide it. That's the denominator. And if you do that division problem, you come out with $14,000 an ounce, which is the high price suit you just mentioned. So that's at 2,000 now. So from that metric, it's 7 times undervalued. And the reason I say that is you go back into history, you'll see where that metric worked. In other words, as Mike Maloney says, gold catches up and does a financial accounting for all the bad printing that's gone on for years.
Yeah.
It did it in 1980. If you do that same math, it's really arithmetic, it's division. If you do that in 1980, what you'll find was that the paper price of gold was $400 an ounce. Yet it peaked at $850 in the spot market January 21st, 1980, which is over double the theoretical true gold price. And we could have gone back on a gold standard. So that was 9 years from the time Nixon closed the gold window. And you would have been able to peg the price of gold at, let's say, 800 and been well above the requirement for a paper price of gold. You would have twice as much. You can think of it in you can think of it several ways. Mainly say, well, we have twice as much gold as we need to meet our obligations, because really 400 is the paper price of gold, and we're pegging it at 800. Or you could say that, we can inflate a lot more paper until we get into trouble. We could double the money supply and still cover ourselves with gold. So that didn't happen, obviously. Yes, it was a one-day event, but gold hung in there pretty well.
Over the past 8 decades, the United States dollar has held sway as the world's dominant currency. However, a coalition of emerging economies harboring concerns about Western dominance in global governance and finance is trying to challenge the dollar's preeminence. This process of de-dollarization, as termed by Russian President Vladimir Putin during a virtual address to the BRICS summit in Johannesburg, is not only underway but also picking up speed. The concept of moving away from the overwhelming influence of the US dollar on the international stage is not new, and it extends beyond the BRICS nations. Nevertheless, experts emphasize that recent geopolitical developments and escalating tensions between the West, particularly the United States, and countries like Russia and China have thrust this idea into global economic conversations. Morgan points out that the BRICS countries seek to conduct international trade using their respective national currencies. However, this endeavor is far from straightforward due to disparities among their currencies and the enduring supremacy of the US dollar in numerous global transactions.
Well, China's having massive problems because the productive capacity of China at this point has too much capacity. There's not enough demand. Mm-hmm. So, and they have huge debt problems, and 30% of their economy is built on real estate. And these big real estate firms are blowing up. And so they're really in a very, very precarious situation. The banking sector hasn't reflected the amount of pain that's in the real estate sector, but it will. So, if you're going to base your BRICS on, all these countries that recently joined, and of course, Brazil, Russia, India, China, and South Africa, and one of your stalwarts, China, which is the second largest economy in the world, is going down the tubes. How's that going to work? It's not. Yeah. It's not going to work. Now, the part that does work is interexchange between their own currencies. So you can trade Brazilian currency for Chinese currency for Russian rubles for South African rand for, whatever pesos. And that's fine. And that alleviates them having to go through the dollar, which is good for those countries. The problem is that even though it's a unified currency, it's just like the euro, because they have different cultures, they have different work ethics, they have different holidays, they have different productive capacities. And because of that, if you are, let's say, a Greece in the euro and you're a Germany in the euro, who's getting a better deal? Mm-hmm. Well, yeah, you could think about it, but they're not the same. And that's the problem. So you've got a country that, let's say, uses their peso to buy your rubles, and the productive capacity of the peso is not the same as the ruble, then how valid is it? The reason that the US dollar is the best shirt in the hamper, is this overused expression, is because all these other countries are inflating faster. We're inflating like hell won't have it. But when you consider what Zimbabwe did with their inflation compared to the dollar is a real king, or the lira, or Turkish lira, or whatever. So right. And is that true, David, in every case? No, it's not. But that's the way the index reacts, is that these other currencies are devaluing faster than the dollar. Yeah. And because of that fact, the dollar looks better than the rest of them, not because we aren't destroying the dollar, we're just destroying it at a lower rate. And of course, the main reason, as we all know, but probably should be said, is because we do have the luxury of being the reserve currency, which is being diminished by the BRICS. But the BRICS currency taking over, it's not going to happen, at least not for a long, long time, in my view. And I'll change my mind. I get better data or something appears that I've missed. But these dollar debts are that. They're dollar denominated. So if you're in Indonesia or, any country that has dollar denominated debt, you've got to take those ruples or those pesos or whatever your currency is, convert them to dollars to pay off the dollar debt. You cannot pay your dollar debt off with the BRICS currency. Can't be done.
As insights provided by DavidMorgan on the potential of gold as an investment and the ongoing shift away from the US dollar, how might these evolving dynamics in the world of finance and investments impact the future of global economic stability and wealth preservation? If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.